Welcome to the second topic in the accounting information system. Today we will talk about transaction processing system TPS, and as we discussed in the last class, we discussed the introduction about the accounting information systems, the objectives, the value added, and so on. So today we will start to go in deep talking about the process of the first transaction. We will have a holistic discussion step by step. Inshallah, we will have good understanding on this. So let's start with an overview of transaction process. First of all, what is financial transaction? Financial transaction is an economic event that affects the assets and the equity of the organization. It is reflected in its accounts and it is measured by monetary or dollar terms. So it will be represented uh, in the first record of transaction up to the financial statement in the end of the year. Now let's have a look into the type of transaction cycles. We have three main transaction cycles, and also there is some supporting cycle that we will discuss later on. So the first main transaction cycle is the expenditure cycle. Expenditure cycles is about expenses, disbursement, buying raw materials from suppliers and vendors, buying properties, buying equipment, buying machines. All of this is considered also part of is under the expenditure cycle. Also, the paying the salaries and wages to the labor. All of this is will be you give cash, you get either you get the materials, raw materials, you get the properties, and so on. Then we have the next conversion cycle, which is the cycle that composed of two subsystems. One is the production cycle, producing the or transforming or converting the raw materials, labor, and so on into finished goods or service. And then the cost of accounting systems, it is kind of subsystem that handling or concerning about the equity of allocating the cost of the production into the finished goods. We will discuss that in separate chapters later on. Then we have the last one is revenue cycle, which is the cycle composed of sales order, selling the finished goods or services to the customers, and then receive cash. It is good also to discuss this and discuss the relationship between those three, and the next slide will explain in better what to call the diagram or figure. So in this diagram showing the relationship between transaction cycles, we have, as we said, we have three cycles. We have the expenditure cycle, and subsystems is purchasing cycle and account payable cycle, cash disbursement, payroll, fixed assets. All of this is under the expenditure cycle. Then we have conversion cycle, have subsystems of production and planning, and also control cost accounting. And then for revenue cycle, we have composed two subsystems: sales order, processing, and cash receipts. Let's see the relationship between those three cycles. As we will see here, the cycle of expenditure, where it will produce, or you will give cash to the labor to get for their work, and also will buy materials, and also buy or acquire machines, physical plants, and so on. All of this will contribute into the conversion cycle, and the conversion cycle will to produce the production, the new product, the finished goods here, or the services. And then this one will it's related to the revenue cycle. By this revenue cycle will try to sell this finished goods or services to the customer and get the cash. So this cash again will go to be an input for the expenditure cycle. So that is good. You see, that's good to understand this relationship and to understand the holistic view of the relationship between those cycles, in order to understand how the system or how the accounting applications and systems understand or try to visualize those relations into a logical manner. To have good understanding of how the recording process of the transaction started, it's good to understand or to how to say simplify this idea of recording for layman man, not for those accounting background and so on. So basically, if you ask anyone how we start, if you are an accountant, and how the accountant will start to do the record of transaction, the simple answer is we start to first identify the amount of the transaction from the source of document, and then we record the details of that transaction. So as simple as that. So let's have discussion in more details in a short while. We will try to explain the recording of transaction based on the data processing cycle. Remember, we are now talking about the system, accounting information systems. For sure, later on we will discuss the basic or the manual transaction, manual record of transaction, and also the automated recording of transaction. But to have better understanding, let's have this discussion based on the processing of the data. So we have, as we discussed last week, the framework of the data transformation is data input. Then we process this data, and it will be stored into that database, and then it will generate information for decision making users. This one has been explained in the previous video about chapter 1. So if you need to have better explanation for each function or each process, you better go back and watch the video. Let's start with the data input first. So steps in processing the input are 3. The first one, capturing the transaction data triggered by the business activities event. And as we mentioned, when we define the business activity event, should be measured by the dollars. Okay. And then we also need to make sure that this captured data are accurate and complete. So in order to record this data, it should be accurate and also complete. This is the 2 conditions. And then lastly, ensuring the company policies are followed in terms of the approval of the transactions, also in terms of the checking as we said, the accuracy and completeness can be done also in this step. In the first step of capturing the transaction, we need to collect information. Collect this information either from activities of interest like sales, disbursement, paying salaries. All of this is the activities itself. And then the resources of effect. What is the effect of these activities into the resources in terms of inventory or cash? Let's say we buy raw materials, then it will increase the effect. It will increase the inventory balance and will decrease the cash balance. So that will we should also collect this kind of information in order to capture the transactions effect. Then people who participated in the activities like customers, employee. If we pay the salary, then we need to capture the details of the participant of if we receive cash or pay send the finished goods to the customer, then customers details should be captured as well. And then we have what we call informations should come from source of document. This information we collected shouldn't come from vacuum. It should come from source of documents. We should have document to support as an evidence to support what we are claiming that this event has been occurred and happened. Let's have a look to the source of document. So source of document, as we mentioned, are used to capture and formalize the transaction data needed for transaction processing. So source of document is the supporting evidence of the occurrence or the happening of that activities or financial transaction. Okay, so the types of source of documents, first is the product documents, which are come as a result of the transaction processing. So let's say you have sent to the customer the finished goods to the customer, then you will send one of the product document is the invoice of what how much is this finished goods is costing the customers, and how much the customer is supposed to pay. What is the second type, which is turnaround documents? Sometimes turnaround document, we will have some examples in a short while and in very simplistic and visualized manner. So turnaround documents are the product documents of one system that become source document for another system. Just now we explained that let's say the invoice sometime when they produce it in from one source documents source as a produced as product document from one system from the company, the selling company, then it will be an turnaround document to be supported supporting the payment. That's what we will explain it in a short while in the next slide. Then journals are the chronological or all records of the transactions. So it's kind of combining the transactions into one list of record. And then we have source document automation, because we are talking about accounting information systems. So we expect that new type, or the beside the manual source of document, we have the source data automation, captured data from machines, point of sales, scanners, or grocery stores. This figure illustrating the creation of source of document. So you can see here when the customer placed their orders, then this is then the process. It will be processing the data collection from customers' order in terms of the date, the quantity, the type of product they are ordering, the customer order, and then based on this process, it will produce a source of document. This source of document, we call it sales order. So this one is this considered source of document. This source of document is supporting the transaction of customer order. So this is the event. Customer order is the event, and the source of document or the supporting document that produced by the internal system is the sales order. And then sales system, this one, or sales source document or sales order, will send to another system to process, which is the sales system. And sales system will produce what we call the bill or the invoice, and this invoice can be used as first it's considered as product as a product document in the first place, but it's also used as a product document, and also it will be used as turnaround document when we do the receiving cash from customers. It will be remittance advance. So that is how it the cycle goes to the customer back. When we send the bill and receive the cash, then it will bring us the turnaround documents. In this complete diagram, we can see that it starts with this process of the data collection by customer order, and then it will produce the source of document, which is the sales order, and this sales order will send to sales system to process and send and also to produce the new document, which is the product document, which is the bill or invoice, and this bill will be sent to customer. The customer, when they send the cash or the check, they will also attach part of the bill or copy of the bill as remittance advice, and in this case it's called, we will call the remittance advice, or we will call the bill in this case as what we call the return turnaround documents, to support the transaction of cash receipt, which will be processed in the cash receipt system. And the simple or the practical example is when you the electricity bill, when you receive it in the mailbox, you will have long bill. This long bill, normally when you go and pay cash into the company, into the Tanaga company or any post office, they will cut this bill, and they will give you a stamp in one part of the bill as a supporting document, supporting turnaround document of your payment. Now let's look into the process of the accounting records in the annual systems. So we take the example of sales order records in the sales journal. So we can see here the economic event is the customer order, and then capturing this event, it will be based on the sales order document, which is the source of document generated by the collection process of the data, as we explained in the previous slides. And then based on the sales order, we will record the events in the sales journal. This is normally this simple represent the journals record. So this figures is illustrating the sales journal. I'll not go through these details because it's just a recall of how the sales journal look like. In the second step in the data processing, which is the data storage, it is important to understand how the data is organized, even in the manual storage or filing. One thing is the chart of accounts, which is can be defined as an index or coding scheme of all financial accounts in the general ledger of the organization or company. And then the transaction journals, let's say sales. Then we have another journal for the account receivable, another journal for another accounts, and so on. And then subsidiary ledger for account receivable, and so on. Then we have the final one is the general ledger. So this is how we store the data in the manual, and then we will also explain the same process of that. For sure, the coding of the transaction, it sometimes take numbers, may take let's say also may take some numbers and mix with the alphabet, and sometimes number may drive, sometimes the sub numbers may drive to certain codes of grouping of product and so on. So let's say number one is the sales, and if it is 1/3, 3 means, let's say, the electricity or the electronical production, like refrigerators and so on. And then if it is 1/3, 5, let's say 5, it means that any product of spare part or anything. So it's just an example. So what I would like to say here, you need to understand the criteria of the data organization, how the data organized in the system, and how it's codified in the system, either the manual or the automated applications or software. Okay, so this figure is explaining the relationship between the subsidiary ledgers and the general ledger. The previous figures, just in a few slides ago, we explained how the transactions is moved from the source of document and up to the journal. And here we from each journal, or each journal, let's say we have the for example, here we have the example of the account receivable. So we have several several subsidiary ledger for each customer. So we have for Hobbs, for Johans, for Smith, and so on. And then all of this, the balances will be recorded here and or accumulated and sent to the general ledger of account receivable. This one is the accumulation of the total account amount, and so on for the other account like cash, inventory, and expenditure, sales, and so on. And those will be derived, if you recall the accounting cycle, it will send to the trial balance statement. Okay, so subsidiary ledgers contains details for each of the individual accounts that constitute the particular control accounts, and then the general ledger contain account information in highly summarized control account.
Now let's have a look into the flow of the information from the economic events from the source of document up to the end in the general ledger. So this figure is illustrating a holistic process of the recording processing the transaction from the starting point by the input of the source of document up to the end of recording the or posting to the general ledger. So normally we start with the source of document, which is sales order, comes from data collection, collecting data and process the customer order. So the internal system will create sales order. From sales order, it will affect or record the sales journal for the record of this transaction, and also it will post to the subsidiary account receivable subsidiary account receivable ledger. And then from the sales journal and other accounts journal will like cash, when they receive the cash, and also the account receivable as well journals, all will be posted to the general ledger. And then from time to time, periodically in a systematic periodically reconcile the subsidiary ledger to the general ledger as a one of the technique to do the internal audit or the audit trail. So in a simple way, general ledger is a book of accounts that reflects the financial effects of the organization transaction as they are posted from various journals to the journal. Okay, so those kind of cycle, all of these accounts records provide an audit trail for tracing the account balance contained in the financial statements back to the source document and even the financial events. Figure 12.2 illustrating the recording and posting of credit sales. So it's also illustrating how the audit trail process for one example is the invoice of invoice number 156. So this is the invoice and this is the amount. We will see how it's connected from the sales journal. This is the sales journal, page 5. This is the references and how it's connected to the other record or the posting. So in the general ledger, we can see that the reference number, which is here, the reference number here is related to up, and also the number or the record number, the record number, that because as you remember when we talk about the general ledger, we said it is highly summarized details list of the accounts. So you can see here only the balance of the transaction posted to the general ledger. But when we see the general ledger, also this is the general ledger for the account receivable, but for the general ledger for the credit sales, for the sales, we will see the same amount here and the same reference number here with the same, for sure, the same date. The same date will be always the same. And then we will have in the account receivable subsidiary ledger, we will have the details of each transaction. So you can see here the amount is 1,876.5. This one is the recorded in details here, but the total of the transactions can be found in the general ledger. So this one just to explain how you trace the accuracy and completeness of the recording of one transaction, and also it can be used as this tracing or watching techniques can be used as audit trail technique to ensure the accuracy and the completeness of the transaction. Just now we discussed the recording of the transactions or processing the transaction in the manual system, and let's have a look now into the digital accounting record based on the accounting information system softwares. So modern accounting system store data in 4 types of digital computer files. Just now we discussed the files that recorded starting by based on the source of document, then we talk about journals, subsidiary ledger, and the general ledger. How about in the digital recording, how it records? There are 4 files you should know in the digital recording in any accounting software. First file is master file. It contains the accounts data. And then we have the transaction file, is a temporary file. Transactions records used to update the data in a master file. So normally we start recording the transaction in the system or the software start to record the transaction in the transaction file which is a temporary file for the transaction record, and then update the master file, which is the permanent file, from the transaction file. And then we have reference file. Reference file stores data that are used as a standard for processing the transaction. Those reference file is considered permanent file for some details that is used also in the transaction, but it is not just related to that transaction. For example, customer name, address, details, phone number, all of this information is in the reference file, and it is when we record in the transaction file, we didn't update the master file with all the details. We just record let's say the sales transaction amount and so on, and the customer number. Then the customer number will be linked to the reference file to extract the rest of details about the customers. Then we have archive file, contains records of past transaction retained for future references, and normally this file, archive file used as digit record audit trail, are less observable than those between the hard copy documents, but they still exist. So in a simple way, archive file is considered the audit trail, support the audit trail in the digital form. Let's look into this figure, which illustrates the digital accounting records in the computer-based system or digital recording of the transaction. We take the example of sales record or sales transaction. So it starts with manual document of sales order, and then we process it and automate it to the system, data entry. Then we will have sales order. This one is the file. This is the file we call the initial temporary file, transaction file. From the sales order, it will update three files. It will update the first the journal. It will update the general ledger, and also it will update the errors file if, let's say, you have transaction is wrong and so on. So and also it will bring the source or the update program. The updating of this transaction will bring information from sales order transaction file, and also the freight charts if there is, which is the reference file for any information related to this. And then this one is the archive file, which is updating the posted and past transactions. And then we can see here, when we update, the system will update in a concurrent time. Same time will update the general ledger, account receivable, and the inventory, the cost, any transaction related ledger, and also will update the subsidiary account receivable and inventories subsidiary file. And then the audit trail will match this data, will apply it when we try to trace the details in master files and match it with the subsidiary files, and as well as the journals file, which is the recording file. And sometimes also we can also compare and match with the error files. Okay, now we see in these figures is trying to show us the data storage elements, as we said in the previous class, when we bring the introduction about the filing, in the introduction about the accounting information system in general. We also come to know the files hierarchy, the data hierarchy. The data is stored in master files or transaction files based on attributes, and this attributes is based on each elemental details about the transaction record. One transaction record: customer order, customer names, address, credit limit, and balance. And then we have the record itself, the full record, which is the full arrow. This full record, this full of customer name, customer number, and so on, all of this is called the record. Okay, so that is the data value. And then the accumulation of all of this records from which is recorded in one file, and this one we call it the individual file. Let's say account receivable file or cash file, which is we can say can be happen in the subsidiary file or the master file. So it is important to understand how data aggregated, as this will be useful in subsequent discussion later on when we discuss the designing query and questions for the data base management and so on. Student should be thinking about what information is in master file and what information should be in the transaction file. So this will help to understand how what is the information in the master file. Master file normally, as we said, it is the posting general ledger, the data that will acquire the financial reporting information, whereby the transaction files is the initial temporary files recording the elemental attributes of the transaction. Now we will talk about data processing. So in data processing, there are four types of processing: either creating new records by adding a new customers, adding new transaction, or are reading existing data, get this data from the data storage and read it. The third one is updating previous record data. So we have also data in the storage data. So we update, either we update the balance of the let's say the credit of customer credit, or if any payment, then we update the cash and so on. And the last one, deleting the data. So if the customer, let's say, finish the payment and receive all the credit, so we delete all the credit amount on it. Or sometimes we cancel customers from the list or suppliers and so on. So that is the four functions that we process or treat the data. So either to create, either or to read and update and then delete. So that's the four types of processing of data. And we can, in order to easy memorizing for it, we can say CROD: create, read, update, delete.
Now we come to the last process, is the information output. Information output now, after we do the data processing, as we mentioned just now, creating new data, or updating the existing data, or deleting the existing data, as we said, or we correct the data. So in that case, we can also read this data, read either from the stored data, and read it in term of either online form, or in term of printing this information in hard copy form, and this either to be documented document as a document, sales invoice, receipt, and so on, or report like monthly sales report, or like the general ledger, the balances, and so on, or trial balance, and so on, and so on and so forth. Then we have query. Query is asking questions to the system, or the data management system, to get the answer from it. For example, which division had the most sales for this month, or such question. We ask questions: who's the highest branch doing the sales for this month, or income, and who's the less, or who's the most active employee this month compared to the previous months. You can ask whatever, as long as this data is stored and processed in a logical way. After we completed the cycle of accounting, or the cycle of the transaction processing system, starting by the input into the storage, and also processing the data, until to the output of the information, generating information. Now let's talk about the approach, or the models of the transaction processing. We have two approach. One is batching approach, and the second one is real-time processing approach or model. For batching process, where we have middle staff who collect and assemble the transactions for, and then key in into the system into the system in one time, specific time. Let's say collect the based on daily or weekly base, collect the same transactions in a groups, and then key in one time. So in the uh, in the other side is the real-time processing system, where it recorded the transaction in the real time, and where there is no delay of the transaction. The time the transaction occurred is the time it's happened, or the time it's recorded. So let's compare between the batch and real-time approach. In terms of information time frame, the batch systems assemble transaction in groups, resulting in time lag, and the real-time systems process the transaction individually as they occur, with no time lag or delay. In terms of resources or organizational resources, batch systems require fewer or less organizational resources compared to real time, in terms of the programming, the costing, the hardware, or the IT infrastructure, and so on. So the reason is because real time require more people to ensure that all transactions occurred has been or have been recorded in the same time. Another thing to compare is based on the operational efficiency and effectiveness. So if we look into the efficiency, then the operational efficiency is where you record all transactions in real time, so you have real time or updated balances for all transactions. But also it is costly. This is a costly decision or costly approach. So especially for non-critical accounts, which is based on unnecessary activities. So the designers and the steering committee of designing the system or the accounting software should do or should consider the trade-off between the efficiency and the effectiveness between the two models of processing of the transaction. The question is now, batch or real time? Which one is more practical, more more popular in terms of using in the real process or real business life? The popular approach is mixing between the two, where both approach are applied in the same processing system. So some aspect of transaction will be recorded in real-time base, and other aspect will be in batch model. By when we this is based on the consideration between effectiveness and efficiency trade-off, as this will be in the base of the critical or uncritical or necessary or unnecessary activities that may affect the business operation and activities. Updating master file from transaction involves changing the value of one or more variable files to reflect the effects of the transaction, and this is for master file normally use both batch and real-time approach. Here in this example, trying to show the real-time process of one transaction or the sales transaction. So we can see that the sales come from first from customer order. So we have source of document, the sales order, then we key into the system data input terminal, and then this zigzag arrows is representing the real-time update. So in the same time, if it is a batch system, then it will be straight arrows. Okay, so data input and edit in the program. So you see that it's in the same time it's editing the data and update it. So also we get account receivable subsidiary file and inventory subsidiary file in the same time to come out or to update the sales order file, and which will create, if you notice, the same time we create the input, it's also generate invoice accordingly. So the then it will update this the update the report on the program, and it will update the sales journal and update the general ledger accounts, and it may create some reports or documents in some after the transaction being occurred at the same time. Okay, so this is also real-time procedures for sales order. In if you see many zigzag arrows from point to another, and you can see this is if you go back to the textbook and check the square shape or symbol is representing the automated process. Okay, for the manual process is this sample, but now it's this square firm square. This is representing manual process. This one is the automated process. Okay, so you can see many transactions or many activities within the recording of the transaction being happened in real time. A related topic we will talk today also about the data processing is the data coding, as we mentioned earlier when we discussed about the account charts and the coding of the accounts and transactions. So also it's very important to discuss the data coding in general.
Basically, the data coding schemes can be defined as transforming the data or the logical data that we see in, let's say, the balances or the name of the customers and so on, into a physical suitable data that the computer can be read. So this one we call it a physical view of the data, and normally it's based on the programming languages available like C or C++ or Java or Python. Those all are programming languages that can be based on. So it is kind of dictionary to use to codify the logical or what we are viewing as a users into computer languages, which is normally based on numeric 1 0 and so on.
In the end of this video, I'd like to thank you all for watching this video, and I hope you gain some new things about the transaction processing system and about the type of models, batch and real time. Hopefully you can go back and view the materials and the video if you don't understand anything, and let me say anything that you would like to have clear picture about in the comment of this video, and see you in next video inshallah next week. Wassalamu alaikum wa rahmatullahi wa barakatuh.